Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I just want to go ahead and talk about a specific stock that's going to go ahead and report earnings tomorrow. As you guys all know, the big bellwether tomorrow is going to be Apple computers. And basically, I am a little nervous on Apple, and I'm going to go ahead and explain to you guys why. Alright, here we are looking at Apple. It has a really negative monthly and weekly trade triangle signal. Now, whenever I see this with Market Club Trade Triangle technology, it generally implies a much longer term downtrend. I've seen it plenty of times, and I will tell you guys that I've seen weekly trade triangles that were bad, but I've never seen a monthly weekly on the Apple chart in quite a while. Now, I'm just going to go ahead and pull back and show you guys a 5-year chart real quick. Get rid of the daily triangles, and I'm going to show you that the only time you ever see a weekly and monthly trade triangle chart, weekly and monthly trade triangle going into the negative, is when there is a sizable, and I mean a very sizable, correction in momentum. Same thing right here, monthly, weekly. Now, if we also include the day trading triangles, you'll also notice at certain points you might see an up triangle, you might see an up triangle, but those I honestly really don't feel that comfortable with Apple right now. But that's just the technical side of it. The thing that really gets me off base right now is the fact that sales have not been that great at Verizon stores. At first they were great, but now they're not so great anymore. And pretty much that's kind of what I sort of found out. And if your sales are bad at Verizon stores in general, and part of it is owed to the fact that the iPhone really can't multitask that. Well, you really can't do more than 2 programs at once on an iPhone based on Verizon's network. So again, sales weren't that great for the iPhone 4, at least from the Verizon end. That's bad. You see, the reason is because Apple has to increase their earnings growth by around 50% from the previous year, quarter 2. Pretty much around 50%, 50 to 60% in fact. And quarter 1 was pretty good, but at the same time, iPad 2 has been around for a little while, and the fact is that Honhai Manufacturing isn't getting as much sales, or more like revenue growth, as it used to. And if the main manufacturing partner of Apple is not getting as much manufacturing growth, and you also have issues coming from the Japanese earthquake, one must ask if there's any rationality behind taking on such large risk into a trade that has shown itself to have a really negative score. This could just be a short-term bounce that could fool you into a much bigger drop. Another thing that I noticed in the options market with Apple is that there's much more puts and hedging going into this earnings season. Now, the reasons are obvious. When you see stocks that grow at ridiculous rates, and all of a sudden they stop growing at that really fast rate, you'll probably see something, you end up seeing something like this, and I'll just give you a quick example. Alright, so basically, here's a chart of Cisco Systems. Last year, in 2010, when management started saying that earnings wouldn't be as great anymore, you pretty much saw the stock take a nosedive. 50% drop. That's a lot of money to lose. And quite frankly, I'm not anticipating something as bad as the Cisco story. But obviously, we all know what happens to tech companies that don't grow and meet investors' expectations. I'm going to go ahead and move on to another example. Microsoft. I'm going to go ahead and show you guys a multi-year chart. And basically, when we look at Microsoft, you guys will tend to notice that there's a huge rally, and then it just drops rapidly. Now, this just goes to say that, of course, that was part of the 2007 market crash, and obviously, at that point, the whole economy was doing awful. But if you guys look at 2010, the earnings from their Microsoft Windows 7 platform really didn't cut the slack that investors wanted, and you're already seeing that the Microsoft stock is pulling back. It's pretty much gone from a grower to something that's not really much of a grower. It's almost, the growth is almost as bad and mundane as owning Walmart stock, basically. You know, some people and some analysts might say, "Oh, Walmart has this great stuff and that stuff is going on, blah blah." But to be honest, I'm not that optimistic on it. And you know, I wish this chart would go back even further. But at one point, Microsoft was actually trading at around $46 per share, and I really can't show it to, I can't show it on this chart. It doesn't go back that far. But at some point, Microsoft was trading at $46 per share. That was until its earnings were growing at a really rapid rate. It looks very similar to the Apple chart, by the way. If you guys just go ahead and look at a 1991 to 2000 chart, Bill Gates was pretty much on top of the world. It was worth over $100 billion, I think, or something like that at some point. And pretty much what happened was that Microsoft's growth was doing awful after the internet bust, and Microsoft stock never made it back to its 1999 highs. So what's the risk here, guys? Well, the risk here is that Steve Jobs is gone. There's a lot of competition entering into the tablet markets and the smartphone markets. You have an opposing platform that seems to be just as good as what you're offering. You see, Microsoft didn't exactly have that issue. It still dominates the operating system space. Last time I checked, Microsoft still had 80% market share. But the story is a little different for Apple, isn't it? You see, the story with Apple is that it's facing some really, really strong competition against Samsung, Motorola, LG, HTC, all under the same platform, which is the Android platform. Along with that, in the tablet space, you got the BlackBerry platform in terms of iPad. I guess you could call it tablets. I don't remember the name or whatever. But Research in Motion basically released a tablet using the Android platform. Samsung did the same exact thing too. So you pretty much got a lot of competitors entering into the same space. And some analysts seem to be just all too optimistic. Very optimistic. And I don't see why you would be so optimistic when there seems to be so much competition entering. And it's going to most likely dent your growth. The software is just as good. The apps are free in the Android apps store. Of course, Apple might have the iTunes, but that could be easily replicated. And as far as I'm concerned, the combined four of those, of Samsung, LG, HTC, and Motorola, do take up a large portion of the smartphone market. You know, at first, analysts weren't really that threatened by the Android platform, but I'm starting to think that it's a really big threat for Apple's profits. The products coming out of the competition seems to be just as good, and in other instances, just seems a tad bit better. You know, the most innovative person at Apple, the visionary that kind of drove Apple into this direction, is more or less gone. I mean, he's out cold. He's sitting in a hospital bed, basically, and we're not sure if he's ever going to recover and come back to Apple. We really don't know that. You see, when Microsoft's stock dropped from its 1999 highs, at least you could say that Bill Gates was still around. Apple isn't around, and Apple is at new all-time highs. Again, it's just food for thought. For as much money as a lot of investors probably have made in Apple right now, a lot of institutions are already taking the opportunity to go ahead and reduce their exposure, to buy some hedges, and to cut their positions. If I were you, I would follow the smart money. The main reason why I would follow smart money is because they generally either have some inside information. Sometimes it's not even inside information. They just know that the odds are kind of stacked against them. Blind optimism isn't really what makes institutions money. The smart money tends to stay smart money because they know how to manage their risks. And at this point, I don't think the risk is really worth it. I don't think that at this point Apple is the right place to be. I think if we wanted to find some growth opportunities, we should look elsewhere. and there are plenty of alternatives. We can always find another company, and I think that Apple right now, it's just not in the place it should be. I'd probably say it's a different story if the same CEO that led us there, led us here, was still around. But quite frankly, he isn't. There's a lot of competition. Manufacturing is down. Verizon sales hasn't been great. Analysts are starting to get negative on it. And there's even a downgrade on it. And it's the first downgrade I've ever seen. And institutions are hedging. And some are flat out speculating to fail, or basically a sell-off in Apple, so they're already selling their positions. So again, the choice is yours, the risk is yours, but I would avoid. If you plan on buying into Apple on this earnings season, if I were you, I'd pretty much avoid it. I think there are better opportunities elsewhere. There's better opportunities in foreign stocks. At this point, Apple is just a bit too risky for myself to recommend or even invest inside of. I hope that helps you guys out a lot. If you guys are still interested in this type of stuff, please be sure to go ahead and check out my videos and my channel, and just go ahead and subscribe. And also, if you guys are interested in the same charting software I use, please be sure to go ahead and check out the link right below this video. Take care, folks, and I'll go ahead and see you guys in the coming weeks and months ahead.